Have you ever met someone who just knew their March Madness bracket was going to win it all, only to end up busting in the first round? Or maybe you've confidently made a big purchase, convinced you'd budgeted perfectly, until reality hits your checking account. That's overconfidence bias, and in investing, it can lead to some costly mistakes. Hey everyone, and welcome back to From Wall Street to Your Street. I'm your host, Ryan Flanders, your financial coach who swapped the sidelines of the field for the sidelines of your portfolio. Each week, we break down a common investor trap and how it can quietly derail even the best financial plan. Overconfidence bias is exactly what it sounds like. We tend to overestimate our knowledge, our abilities, or our control over outcomes, especially when it comes to money. It's that inner voice that tells us, I've got this, even when we may not. I once worked with a client, we'll call him Zach, who was convinced he could beat the market by picking his own stocks. And he had a few early wins, especially during a bull market. And his confidence soared. He stopped checking in with us, he started trading more frequently, and he even joked that he might retire early. Then came the market correction. A couple of his tech-heavy bets tanked, and instead of adjusting, he doubled down. It wasn't until a significant portion of his portfolio was underwater that he reached back out. What he learned, and what we can all learn, is that success in investing isn't just about being right a few times, it's about staying disciplined over time. So how does overconfidence show up? We see it in ways such as trading too often, thinking that we can time the market, ignoring diversification because we know what's going to perform, dismissing advice from professionals or experienced investors, and assuming past wins were skill and not luck. Now that we know what it looks like, how in the heck do we beat it while still remaining confident in our decisions? A couple easy ways would be to 1. Review your track record honestly. Are you beating the market or are you just riding it? 2. Diversify your portfolio and rely on process and not gut feelings. 3. Get second opinions. Accountability matters. 4. Use a written plan to guide decisions and not recent wins. Let's dig a little deeper into why overconfidence is so tricky and why even really smart, experienced people fall into this trap. Overconfidence bias isn't always loud. Sometimes it shows up quietly as subtle certainties. You've probably heard someone say, I've done the research, or I just have a feeling about this one. And that's what makes it dangerous. It doesn't feel like a bias. It feels like confidence. Psychologically, we tend to give more weight to our own experience than to the broader data. So if you've had a few good calls, whether that's picking a stock, timing an entry point, or avoiding a drop, your brain logs that as evidence that you know what you're doing. It's validating. But the market doesn't care about your track record. Another reason overconfidence shows up, the illusion of control. Another reason overconfidence shows up, the illusion of control. When we're making active decision, it feels like we're in control of the outcome. But in investing, especially in public markets, involves a lot of variables that we can't predict. Macro trends, interest rates, earnings, geopolitics. Even if you make the right call, timing, execution, or broader factors can still throw it all off. Study after study shows that frequent traders, especially individual investors who act on confidence, tend to underperform the market. One famous study by Brad Barber and Terrence O'Dean found that investors who traded the most earned significantly less than those who traded less frequently. Barber and O'Dean analyzed the trading activity of over 66,000 individual investors over a multi-year period, using actual brokerage account data, and the results were pretty clear. The investors who traded the most, the ones constantly buying and selling, trying to time the market or chase the next big opportunity, underperformed the broader market by a significant margin. In fact, their net returns were about 6.5% lower per year than the buy and hold investors who made fewer moves. That's not just a small dip. That's the kind of gap that can completely change your long-term financial outcome. And what was the root cause? Barber and O'Dean pointed directly to overconfidence. These investors believed they could spot patterns, pick winners, or time reversals. But more often than not, they were wrong. And even when they were right, trading costs, taxes, and mistimed exits chipped away at their gains. The title of their study says it all. Trading is hazardous to your wealth. The investors weren't failing because they were uninformed. Many of them were smart, engaged, and analytical. They were failing because they believed that they could predict what was coming next, and then they acted on that belief too often. It's a powerful reminder that even intelligent, well-meaning investors can get tripped up when confidence overrides process. Why? Because confidence leads to action, and too much action in investing often leads to friction, trading costs, tax inefficiency, and timing mistakes. It's not just what you buy, it's when, how often, and how consistently. Let me be clear. Confidence isn't bad. In fact, it's necessary. You need confidence to stay the course, to invest during downturns, and to ignore the noise. But confidence without discipline, that's where the danger lies. It's the difference between trusting your process and believing your gut is always right. The best investors have confidence in their plans, not their predictions. I like to say, plan like a pessimist, act like an optimist, meaning build your investment strategy with risk in mind. Diversify, plan for volatility, use historical perspective, and then carry it out with optimism, knowing your system can weather the storm even if you don't always call the next move correctly. So, if you've ever made a bold call that didn't go as planned, you're not alone. We all have. Overconfidence bias isn't something that you eliminate, it's something that you manage. And the first step is recognizing when it might be showing up in your decisions. Ask yourself, am I relying on process or just instinct? Am I checking the data or assuming that I'm right? Am I open to being wrong or doubling down? The investors who win over time aren't the ones who avoid mistakes, they're the ones who build systems to recover from them. And that's what long-term success is really about. The truth is, confidence is important. It helps us take action, stick to our plans, and stay the course. But overconfidence, that's where we get into trouble. It's when we start making assumptions, ignoring risk, and believing we're smarter than the market itself. The best investors aren't the ones who always guess right. They're the ones who build systems that don't require perfect predictions to succeed. If you're enjoying From Wall Street to Your Street, don't forget to follow, leave a quick review, or share it with someone you know who's navigating their own financial journey. Next week, we're talking about herd mentality, why doing what everyone else is doing feels safe, even when it's not. I'll see you then. Until next time, stay steady, stay thoughtful, and remember, it's not about beating the market, it's about building a plan that works for you. Securities and advisory services offered through Commonwealth Financial Network, member FINRA SIPC, a registered investment advisor. Fixed insurance products and services are separate from and not offered through Commonwealth. The Flanders Group is located at 221 Maitland Street, Bel Air, Maryland 21014. Phone number 410-569-4506. Investments are subject to risk, including the loss of principal. Some investments are not suitable for all investors, and there is no guarantee that any investing goal will be met. Past performance is no guarantee of future results. Talk to your financial advisor before making any investing decisions. The client example presented in this podcast is for illustrative purposes only and should not be construed as a recommendation. It may not be representative of your experience.